Welcome everyone. This is the Center for Governance and Markets. We're a research center here at the University of Pittsburgh, and we are thrilled to bring you this week's installment of our virtual seminar series on networked governance. Can we govern ourselves digitally? And this week we are delighted to have with us Jason Potts, all the way from Australia, from RMIT University. And before we introduce Jason, I want to introduce to you my colleague. Actually, before I introduce my colleague to you, I actually have some news for all of you. So for those of you who are in Pittsburgh, I need to mention this right now. Tomorrow at 12 p.m. Eastern, we are hosting Pittsburgh Mayor Bill Peduto for a roundtable seminar on police reform in the city of Pittsburgh. And we're going to be joined by two esteemed scholars who will quiz the mayor, and that event will be open to the public. So you can look at our website, cgm.pitt.edu, to find more about that. So now we're here to talk about digital governance and the digital economy. And now I'm going to introduce to you Eric Alston, who was our guide this semester on these issues. So Eric, we're thrilled to have Eric this semester. He's a scholar in residence in the finance division and the faculty director of the Hernando de Soto Capital Markets program in the Leeds School of Business at the University of Colorado Boulder. He has such diverse research interests, I don't even know where to start. But he's also a research associate with the Comparative Constitutions Project at the University of Chicago, and is a prolific author and scholar in his own right. So Eric, I'm going to hand it off to you, and you're going to introduce our guest.
Awesome. Thanks so much, Jen. And just as a quick kind of review, this is all about digital governance, which is one of the areas that the Center for Governance and Markets focuses on in pretty exciting ways. And so we decided to pull together a roster of speakers this fall that we think are at the very cutting edge of thought in this area to stimulate further discussion. As with both of our prior meetings of this seminar, they've gone over our additional Q&A time of half an hour. And so we have stimulated some really fascinating discussion thus far, and I'm sure today will be no different. Today is an interesting pivot from what we've had thus far, though, because we've considered first Bitcoin as a distributed versus decentralized payment mechanism itself. And following that, we heard from Nick Cowan examining a variety of potential use cases where blockchain could well disrupt established organizational processes, but this was more on the micro level. Now we're hearing from Jason Potts, who's a professor of economics at the Royal Melbourne Institute of Technology, or RMIT for short, and is also the director of the Blockchain Innovation Hub there. I've often envied his ability to be an international man of blockchain mystery, jetting around every conference that I'd like to go to, as well as a good number I see him at here in the United States. But Jason's written a lot from a very fascinating lens using Austrian and institutional economics to disentangle a variety of complex organizational problems. So it's no surprise to me that he's so interested in blockchain in particular. And with that, I will hand it over to Jason, reminding everyone that this talk is roughly 35 minutes. Please direct message me if you'd like to interrupt Jason with a clarifying question, or even a discussion question during his talk, because we want this to be a bit of a research feel to the seminar. Following Jason's 35-minute talk, we will then have roughly 25 minutes of Q&A with 30 minutes of flex time for anyone who wants to just stay with the discussion even longer. So with that, I'll turn it over to Jason.
Hi, thank you very much, Eric. Can I just check that this is screen shared now? We are good? All right, thank you, Eric and Jane. So as Eric indicated, I'm Jason Potts. I'm a professor of economics. My area is innovation economics and economics of new technology, and I've been interested in the blockchain space for quite a number of years now. The Blockchain Innovation Hub is actually a lot like your own research center. It's an interdisciplinary group of market-oriented sort of Hayekian type economists, lawyers, very much interested in sort of constitutional and governance aspects, with a mix of accountants and historians and sort of a broad sort of social science mix. And the remit that we have we're funded by the university itself, to build a research center that is seeking to understand the coming sort of blockchain economy, or the digital economy, or just to really try and understand the impact of this particular governance technology on how this will reshape economic organization. And what I want to do is to talk broadly to that topic. I'm pleased to follow up from Nick Cohen's talk last time to try and extend that out. I'll be following similar themes, but the purpose of today's talk is to really try and pull this all the way back and get a sense of what the prospects of digital governance actually are, what this means in particular for public policy. And that's where I want to end with this topic. So our research center, we've been doing quite a bit of work in this space. Broadly around the area of digital governance. We've produced a number of books and papers about different aspects of this. And I've named this particular talk after one of these papers, Capitalism After Satoshi, but I'll be broadly drawing upon all of these topics and themes, and to try and sort of draw out some really high level general principles that I want to conclude with in the sense of what I think this actually means, in particular from a Hayekian perspective. But this is the themes we're going to cover. All right, so high level, what is the concept here? So if we think of it as one of the big lessons of the 20th century was, and it was sort of Mises and Hayek taught us this, was the significance of how market economies or market societies destroyed feudalism. Like that was the sort of big shift from Marxist feudalism. The significance of blockchains are, I think, they eat corporatism. What they do is, in the same way that a market economy destroys a feudal economy, a blockchain economy destroys a corporate economy. And I want to just dig into what the meaning and implications of that are at the micro level, but also all the way out to public policy. And if that's just to sort of put some flesh around that specific idea, the logic of it is that the markets eats feudalism is markets decentralized coordination mechanisms beat centralized coordination mechanisms. That was what was going on with markets of feudalism. And it's the same argument with corporatism and Leviathan, and just is that a decentralized coordination mechanism under a broad range of circumstances that I'm trying to elaborate and dig into will generally be more efficient than a hierarchical coordination mechanism. And I think that's the sort of big, what is a blockchain economy, or what are the implications of a coming digital economy, is it goes well beyond this first wave, which I'm guessing you would have picked up in the first two talks around sort of Bitcoin and so on, around disintermediation. The idea that blockchains sort of disintermediate markets. What the argument that we've been making in the work that we've been doing around governance is, it's not just disintermediation, it's also de-hierarchicalization. And it's a big, long, clumsy word, but I think it's incredibly important because a lot of the public policy implications of blockchain follow not from the disintermediation, but from de-hierarchicalization. So this is going to be the broad theme I want to talk to. All right. So stepping back, what is blockchain? Blockchain was the technology that was pieced together by Satoshi Nakamoto 10 or so years ago for the purpose of doing a particular thing or solving a particular problem in relation to digital money. But from the perspective of why economists are interested in this, the significance of blockchain is it's a decentralized economic mechanism. It's in the same way that markets are decentralized economic mechanisms, so too are blockchains. That's the reason that we're interested in these. So I want to try and make a distinction between how we develop an economics of blockchains on the understanding that what we're dealing with here are decentralized economic mechanisms. So a number of years ago, and I think it was Vitalik Buterin who developed this concept, but the concept of crypto economics emerged. a number of years ago, which was an understanding of how you apply game theory, or particularly, especially mechanism design, to the design of blockchains, right? And this was essentially using, the problem there was, how do you just, blockchains are in part economic mechanisms. The particular incentive mechanisms, we can use game theory to design that, or mechanism design in particular. And the application of the intersection of economics and computer science and blockchains there was what was called crypto economics. So this was an understanding that blockchains as decentralized mechanisms can be, or we can use economic theory to understand the way in which blockchains can be designed. So let's call that crypto economics, right? That's why a lot of economists have been interested in blockchains and mechanism design. The other name for that is token economics, or crypto economic systems, and so on. But that's the math side of that. What we've come up with is a sort of a broad economic framework that starts at that point of, we can use economic theory, in particular game theory, to design blockchains. But that's not the same question as how do we analyze the implications or working of a blockchain economy? And I want to distinguish those out. So crypto economics is game theory applied to the design of blockchains. Institutional crypto economics is the application of economic theory to the understanding of what happens when those blockchain decentralized mechanisms get into an economy. What does this look like? So what we've called institutional crypto economics, and we've put out a few papers on this, and it's summarized in this book, which is finally now out in paperback, is a hybrid of crypto economics itself, or blockchain, plus Austrian economics as decentralized market mechanisms, plus new institutional economics in the Williamson, Coase, Ostrom sense, where we're dealing with distributed, or the problem of contracting under uncertainty and transactions cost implications. So Austrian economics from a decentralized market mechanisms, new institutional economics from a transactions cost contracting mechanisms. And this also extends into public choice theory in this sort of Buchanan-Tulloch sense, for reasons associated with the need to develop constitutional rules and collective decision-making. And this also then leads into not just Elinor Ostrom, but also Vince Ostrom's work around the economics of governance and collective decision-making and governance of common pool resources and so on. So that notion of institutional crypto economics is focused upon the way in which we can use blockchain technology as a technology to understand economic organization, whether it's through, and specifically decentralized economic organization, whether it's through market mechanisms or hierarchical mechanisms or commons or clubs or other sorts of things. So that's the idea of what we mean by institutional crypto economics, is the application of these branches of economics to the study of this particular, what we think of as useful to call an institutional technology. And this is another, I think, just sort of key analytic building block that we've realized is significant and useful here. Now, institutional technologies contrast with industrial technologies. So industrial technologies are in the Schumpeterian sense of all of the technologies that, iron and steel and chemicals and electricity and so on. All of the technologies from Industrial Revolution on that we think of as changing the structure of an economy, or that industries and firms and so on to organize themselves around. Most technological change is industrial technological change. Institutional technological change, which is technologies for the organization of people rather than technologies for the organization of things, industrial technologies. Institutional technologies are very rare. These are things like money. These are things like the joint stock company. These are things like essentially any situation where you have a system of rules that is adopted by a group of people, and those rules are then used to coordinate the people. A firm is an institutional technology, money and payments are institutional technologies, blockchain is an institutional technology. Governments, in that sense, are also institutional technology. So there's two sorts of technological change we see in an economy: industrial and institutional. Most technological change is industrial. Institutional technological change, far rarer, but when it happens, it has the same class of effect. It dramatically lowers the cost of doing something and increases productivity. But in this case, institutional technologies dramatically change the cost of coordinating and organizing people. It's a governance technology in that sense rather than a transactional technology. So that's the thinking of blockchain as a decentralized mechanism and an institutional technology is a very useful analytic building block to understand why this technology is different. In a sense, blockchains are just open source software. They're in many respects, they are instances of technological change, but they are technological change that has its main impact on governance and economic coordination rather than on production and consumer-facing outputs. That concept has been explained. That's the way an economist would explain it. We found that a lot of computer scientists have a similar understanding of it, but they just use slightly different language to express the idea. And that's what is meant by Web3. Web3 is this notion that what we've been observing over the past 50, 60, 70 years is the evolution of the web, of the internet. And that has gone through a number of different phases. And the first sort of Web 1 was the Internet of Data, which is messages. That was computational phone system. Take a telephone system, can send messages and add computing to that. So the breakthrough technology there was email. But that's a messaging communication system, Web 1. Web 2 was communities, and that's the more recent one, the social internet. You know it as Facebook and Google and so on. But what we got there was the use of the internet to build and organize people, not just sending messages, but actually building and structuring organization. But that was intermediated. You still relied on Facebook or a central corporation or organization to perform that coordinating function. So social internet. What is Web3? I think it was the Tapscott started calling this the Internet of Value, which is not a bad phrase. But what the way to sort of think of that is that what happened then was digitally internet native economic institutions. So cryptocurrencies and smart contracts and registries and non-fungible tokens and self-sovereign identity and so on. What we had there, the significance of Web3 is that this is the first time we actually have economic institutions, i.e. institutional technologies built on the internet. And it's that intersection of the internet plus institutional technologies, here called Web3, previous slide we called that institutional technologies, that is the significance of this technology. This is why this is not just another technology in this space of thousands and millions of technologies that come through an economy. This is one that is transformative in this particular sense. All right, so putting that together, institutional technology plus Web3, what we've found this useful to think of then is this blockchain is economic infrastructure. It's next generation digital economic infrastructure. And that's a way to understand what this is as an economic good. It's not a class of consumer, it's not a product, it's not a consumer good in the end. It's economic infrastructure, but it's economic infrastructure that disrupts the way in which economic infrastructure has been built for the past thousands of years, which is to treat it as a largely as a public good, or a thing that governments provide, or nation states provide, or kings provide, or some kind of central Leviathan political organization provides economic infrastructure upon which to build an economy. What blockchain does is it facilitates and dramatically lowers the cost of private economic infrastructure. And that private economic infrastructure, and I believe this is what Nick was talking about last time, this then extends up to coalitions of private economic infrastructure. Those coalitions we can think of as industry groups, industry collectives, clubs in the Buchanan sense, commons in the Ostrom sense. But what we have here is new economic forms of governance for the organization of economic infrastructure. And this is infrastructure for digital technologies to build upon. And again, the significance of digital here is non-rivalrous, in the sense that it doesn't run into these problems of congestion and scarcity in the same way that rivalrous infrastructure does. So it's a lot of sort of backstory to the argument, but I want to sort of emphasize that this analysis of what blockchain is, digital economic infrastructure that is that is technological, a consequence of technological change, but technological change driving institutional, giving us a whole new sort of institutional layer in the economy. So with that notion of blockchain as economic infrastructure, we've found this a useful way of thinking about what that then means for unpacking it into law. If you think of blockchain as infrastructure or utilities, utilities just means shared capital goods, in the sense of a production process benefits from shared capital goods. Now, normally these are things like, road and rail transport systems, or water and, communications utilities, and, internet, rail, water, and so on. The logic of why those things, there's a number of different sort of reasons associated with why those things are treated as utilities or infrastructure rather than public goods, but rather than as private goods. But the basic logic of why governments provide those things in the Douglas North sense is that the public provision of that infrastructure lowers transactions costs. It facilitates both economic production and transactions. It's this notion of public infrastructure to lower both production costs and transactions costs, which works well. I mean, but obviously there's some constraints on that. But that's also the nature of money. Money is also a public utility in that sense, when it is provided by government as a way to sort of have a standardized unit of account and means of store of value and so on. So what blockchain is doing in this sense is it's opening up entire new possibilities for economic utilities to be provided, where they're extending into the space not just of money and public finance. So we now have the prospect of private monies and as well as public money, but also into the space of registers, asset registers, identity registers, into the space of public administration and regulation. And this is another interesting one, that blockchain as economic infrastructure enables ad hoc private regulation, such that whatever the rules, whatever is coded into the protocol becomes the rules governing trade on that protocol, that can be agreed by the community that's using it rather than externally. So you have this notion then of a infrastructure for private regulation. And public safety and defense in the sense of providing cybersecurity and other aspects of that. So what this looks like then is that we end up with an extension of this model of economic infrastructure and utilities beyond just the standard industrial argument around lowering transactions cost toward property protection and maintenance, creation, and protection of property, and the extension of that. So this is the sort of the lens that we think is a very useful way of thinking about what is the significance of this technology from the perspective of as digital technological infrastructure that is fundamentally a sort of not just a production industrial infrastructure, but as a property rights infrastructure and as well. So this is the way in which we think it is a useful way to frame blockchain. Now, where
Jason,
this observation goes, yes.
If I might interrupt for a second, your slides just came up again. So they were off for a moment and now they're back. And it's been telling me that your network bandwidth is low. So I'm wondering if while you're giving the slides, your voice has been coming through crystal clear 100% of the time. So of things to go down, I'm glad it wasn't your discussion, because it's been completely coherent on my end. But I'm wondering, while you're on your slides, maybe if you throttle your video, that might help. We are across a very large pond from you at the moment. So
let me try and, all right, I'll try and make that happen.
Your slides are nice and up now, so I don't know what was going on previously, but
Oops.
I have a way of, I think, stopping your video myself, but I dislike using coercive digital means.
I'll try and get to that. Which slide are we on now? Is this the blockchain as
equals economic utilities?
Okay.
So I see water and energy utilities, transport utilities, communications utilities, et cetera.
Sorry, let me go back then.
Was anyone else having an issue? Just jump in the chat box, not vocally if you were, just because I'm wondering, it could be on my end. Things have been bad with my municipally granted public utility internet here in Colorado. So
things are kind of behind. I'm wondering if Jason can just turn off his own video camera, and that way.
Yeah, I'll do that right now. Let's see if that.
you got a nice handsome thumbnail of you to stand in for your video.
Thank you. Right, that's probably better then. All right, so what are we seeing now? We're seeing blockchains as a cozy and transactional.
Let's see, double click to enter full screen.
It's interesting how much of a lag there is with screen sharing. Here we go. It's up.
All right.
We got it.
All right. Okay. So, so what that's the way in which we've been thinking about that then is that this is an institutional technology that lowers transactions cost, and that's the fundamental way of understanding that the economic significance of blockchains. It's not a production technology; it's an institutional technology, and institutional technologies lower transactions costs. And as Coase taught us, when transactions costs change, so does economic organization. All right, so that's the logic about why the logic of how to think through the economic implications of blockchain is this is going to change the the structure of economic organization. The other sort of point to note about that is, and this goes back to the economic infrastructure story, is that we've been thinking of this as this completes the Hayekian revolution. The first wave of the Hayekian revolution was the notion of essentially markets, pushing markets into as many corners of an economy as you can, right? And that's using decentralized market coordination mechanisms over centralized computational coordination mechanisms, the socialism versus capitalism story. But the thing about that 20th century model of institutional decentralization was it left ledgers, i.e. the record keeping part, fundamentally centralized. So you've got decentralized market coordination with prices, but you've still got centralized registries. You've still got, this is government identity, property titling, and all of the sort of notions of registries. What blockchain does then is it facilitates not just market decentralization using price coordination, but it pushes that all the way down deep into the administrative record keeping of an economy and decentralizes the administrative base layer of an economy as well. So that's the sort of the broad sort of conception of what, why this technology is blockchain will do to the 21st century administrative parts of an economy, what market mechanisms largely did in the 20th century was just push markets everywhere. Here we're going to push registries everywhere in a decentralized way. So are the slides keeping up now? Just shift to...
We're still on blockchains are a cozy and transactional revolution on my screen.
Wow. All right.
I see Hayekian, Hayekian administrative revolution. So there might be just like a slight lag we're dealing with. And now we're after Hayekian.
Okay. All right. So the implication of that was then just to ask the question, just, how much value is at stake here? So we did some work a couple of years ago, just trying to sort of get a rough outline of the potential value of the cost of trust that we can expect to see in this. And we did this just by adding up all of the jobs. We used US census data for this. All of the jobs that basically involve just keeping track of records in an economy. And this is the implication that when you've got centralized record keeping and monitoring, these are all costs of trust of using an economy, of transacting and trading. The estimate we came up with was, it's very much a back of the envelope calculation, but it was alarming, an alarmingly high number. We estimated around about 1/3 of the economy actually consists of just keeping track of records and updating records and monitoring anyone who gives you any information in a system. That's, in a sense, that's all of accountancy and large chunks of management and just all of the monitoring and so on. So there's a significant opportunity for value creation by automation of that administrative technology in that. So that notion of that's what we mean by cost of trust, and as a benchmark sort of estimate of the scale of cost of trust, it's of that order. All right, so cost of trust, the way in which the way to frame that then is we can think of what do governments do? I mean, governments are an economic technology or an institutional technology to enable two citizens to lower their transactions costs of trading with each other by lowering the costs of trust, by having shared record keeping, shared identity management, shared court systems, shared registries, and so on, right? So this is a way of thinking about the economics of government from this blockchain cost of trust lens, is that blockchains are in the business of manufacturing trust. They do it relatively expensively, and in the sense that whatever the cost of running those administrative apparatus is. What is a blockchain? Blockchain is just simply a technology for industrializing that process, right? You can think of, that's literally what the costs of mining actually is it's a technology, a cost that enables two parties, say Alice and Bob, to lower the cost of transacting with each other through this process. So from that perspective, blockchain is a industrialization of trust technology. And what it is competing with is alternative technologies for manufacturing trust, which in this case are centralized registries, government courts systems, and administration systems, and various record keeping. So again, just to really sharpen up this idea that what we're dealing with is an automation technology, but an automation technology that's going into a space that we very rarely see being subject to automation. All right, so that. I want to sort of switch gears now and just go to the second part of the talk, which I promise will be a lot faster than the first half. But from that lens, what we've now got is a generalized governance technology that is providing economic infrastructure wherever it needs to be or wherever it goes. So the first place to find this is at the micro level. And again, I believe sort of Nick Cohen would have been talking about this, but this is just the logic of governance tokens. Governance tokens are just ways of throwing down a cheap, easy, fast mechanism for a community to come together and vote or make decisions about a collectively owned resource or upgrading the code base or management of a group assets. Again, that competes with hierarchical organization, or that competes with firms. So this notion of sort of governance tokens, which again is very, very new. We've seen this experimented with mostly in the DeFi space, just literally in the past 6 months. We're starting to see governance tokens emerge. But what the significance of governance tokens are, they are the same argument at the micro level with the ability to suddenly and very cheaply throw down the ability of a community to come together and make collective decision-making about shared infrastructure and assets. That's new and fundamentally disruptive of corporate organization. We can think of the price of writing rules has significantly fallen. Now, again, this goes to the question of what cryptocurrencies and governance tokens are, is that they're just a new form of a new technology for coordinating groups of people to come together that don't use debt because they enable they can be targeted on very specific assets. They're not equity because they're rules-based rather than discretion-based, but they're not money either because they're because they're rules-based and not discretion-based. So just as a sort of side point, this is what they technically aren't money, debt, or equity. They're actually dequity. This was a concept that Oliver Williamson developed back in the 1970s. But these governance tokens and cryptocurrencies, in the sense of what are they? They're actually a new type of economic object that has the rules-based the rules-based aspect of debt, in the sense that there's very specific rules governing what they do, but they work with they work with very specific assets. So you've got this interesting notion of what these why these new institutional technologies are actually a new type of governance object. All right. So what does that mean for public policy? So the points that we made in this paper, which I'd circulated earlier for your consideration, is just if you take all of these arguments together and go, okay, what does that then mean for economic regulation? Is that the overarching idea, and we'll put this in the context of the long run of capitalism, is that a lot of existing regulation that exists, and this is antitrust and competition policy regulation and all of the various ways of regulating corporate and industrial activity. The reason a lot of those regulations exist is largely to deal with the negative consequences of hierarchy, right? And we can see this story play out over the combined 19th and 20th century, where you have industrial revolution comes along, starts pushing new technologies into the economy. The efficiency effective and efficient way to exploit those technologies was to build large corporate entities that could gather capital together and create scale economies. Those scale economies were able to drive prices down and so on. So there was lots of large scale macro beneficial outcomes. But there was also this also started to run up against both welfare and competition policy pushback, which we mostly saw in the early 20th century with the rise of the welfare state and the rise of industrial and policy, regulatory policy to try and control those enormously efficient and powerful economic hierarchies, right? So broad argument here being that a lot of the rise of government from a welfare perspective and from a corporate regulatory perspective was largely in response to, as a reaction to, a political reaction to the rise of large-scale industrial hierarchy. And again, the rise of that hierarchy was a very, very good thing for economic growth and welfare, but it created a political response that meant that we've ended up with a relatively large regulatory state, welfare state, and significant size of government. The basic capitalism after Satoshi argument is just simply that because blockchain technology undoes and dissolves a lot of that hierarchy in the first place, it equally dissolves the rationale for the regulation governing it. So this is the and again, this isn't just through industrial policy. You'll see the massive growth of innovation policy in the late 20th century was largely a response to the way in which industry policy increased the costs of innovation, which meant that innovation itself became centralized and corporatized and publicly subsidized. So you end up with a lot of public policy responses were largely countervailing responses to the growth of hierarchy in that sense. And this is how we've ended up with this weird equilibria of both wealth and growth, plus large levels of government and centralized intervention in that economy. So let me just jump through here to the final point. So I'm aware that the slides are probably just catching up, but the final argument here then is blockchain technology as economic infrastructure significantly weakens the or outcompetes hierarchic governance. It lowers the cost of trust, which was previously provided by hierarchic governance, which means that this lowers the economic efficiency of hierarchic corporate forms of organization. The second order effect of that is that a lot of economic policy that was designed and developed in order to constrain and control large hierarchic forms, whether this is competition policy or antitrust policy or corporate regulation and just other ways of having social control of large corporate forms. That just simply becomes less necessary. It becomes a thing that is it may persist for other reasons, but the economic rationale for it evaporates due to the ability of an alternative, better, cheaper, faster, more localized governance technology. And I think that's the historical, so the economic significance of blockchain is lowering transactions cost of trust. That changes the economic structure. The historical significance of blockchain is what that then does to regulatory policy, is it weakens and potentially ameliorates the main arguments for regulatory governance of corporate forms. So that's where we see this going. So the implication of that, and let me just finish a final slide here. What we have then is a technology to facilitate far more targeted precision governance. Right? So this is the final. What is the implication of blockchain as a governance technology? Is because it enables private groups to come together, clubs and commons, making use of their local information and knowledge of time and place and specific requirements. You can have far more targeted governance technologies that are fit for just a particular thing. That targeted precision governance will outcompete, and this is the normative argument, or the positive argument here, will outcompete blunt whole economy governance, that is regulatory governance, that is being provided by governments at this stage. So this is, I think, where this eventually goes, is blockchain technology, a tool for creating digital money on the internet, but from an economic perspective, lowering the cost of trust and lowering the cost of transactions and governance. Lowers the cost of experimental governance. It enables temporary pop-up economies or pop-up sort of governance, and it lowers the risk of, or the harm from, what we might call governance externalities. This thing where a particular rule is just implied as a blanket rule for everyone because of the cost of having targeted rules for particular people. So what do we see? The argument that my team has been making about this is that this is actually Hayek 1945. This is an efficiency argument, but instead of an efficiency argument for individuals using their local information and market coordination, this is actually an argument for groups of people to have access to a technology that enables targeted, precise, low-cost governance around, for ad hoc, small-scale, experimental purposes. Ultimately, this will lead to far more complex governance. This would be a step up in institutional complexity, but it is a step down in the cost of that governance. And we put this all together. That is the argument, or this is a way of sort of understanding the institutional nature. I mean, the institutional revolution that blockchain technology is bringing. It's of the same order of markets into societies, but facilitating distributed, low-cost economic governance. And I will stop at that point.
Excellent. Thank you so much, Jason. On my end, the slides were kind of coming through at an odd pace. And so my first question is just going to be, can you share the slides as PDFs with us after the fact? Because I know there's some strong interest at a minimum on my end, and for self-interested reasons among my students, because I'm going to be exam questioning them on this as well. So at a minimum, the three of us that would like it, as well as the students of mine that couldn't make it. But if anyone has questions for Jason, please jump into the chat, although I'm aggressively interested enough that I'm going to exercise the moderator's prerogative to ask you my own question. And this surrounds, very Williamsonian notions that I'm sure you're familiar with about the inevitable incompleteness of contracts, and another way of thinking about contracts, which is as the relational. And I want to put this in the context that we're living in right now, which is, I think a lot of firms are currently enjoying the benefits of an organizational culture that they created pre-pandemic. To put it differently, some firms are going to have some interesting consequences to their organizational culture if remote working persists long enough, because of the benefits of in-person human interaction in facilitating the development of organizational forms. And so I guess, and I'm not firmly in this camp, but one way to view a firm would be to, given contractual incompleteness, would be to view it as a nexus of incomplete contracts among individuals. My boss can never specify all the things he expects of me, but that doesn't mean I don't think he's not expecting them of me. And so my only, I guess, my counter argument or my query to you is, which aspects of human interaction in firms are tractable to blockchain facilitation, and which ones are, you know, less tractable, that come up against that inevitable boundary of contractual incompleteness? And if that question was incoherent, I'm willing to try to rephrase it.
Yeah, no, it's the right question. So I think there's two broad answers to that. The first one is, this is a discovery process, in the sense that, you know, we start with the things that we've already got fairly clear digital boundaries around, that can be tokenized and shared and so on in that space. And then, you know, which in the sense that started off with money, right? So, and then we extend that out to tokenized assets, and we'll extend that out to, you know, other forms of contracting that can be digitized. But I mean, this is kind of the point, is that the limit of these contractual completeness are the limits of digitizability of the real world, and enforcement of that. So there is a technical aspect to this where advances in, you know, Internet of Things perhaps, or monitoring technologies, or, you know, VR and just all sorts of other ways of just digitizing the world, and ensuring the and ensuring the security of that, or the verifying that extend that space of contracting possibilities, right? So at the moment, so I think there's that aspect exists first, and that's kind of that's a thing that the sort of Williamson Hart logic around you know, limits of contractual incompleteness always ran into a wall against that, because the assumption was it was always human to human contracting and monitoring and so on. So this ability to put essentially to put machines in the loop, and other sorts of digital automation in that loop might well dramatically push back that frontier of complete contracting a lot faster and further and faster than we think. And my guess is that that's going to be a huge growth sector. I mean, it kind of is already now. It's just essentially taking a whole lot of digital IoT, smart devices, AI, blah, 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 blah stuff, and interacting that with governance tokens, or just things to enable the humans to coordinate with that. So I think that space of technological advance is one major answer to that question. So, and in that sense, I'm incredibly optimistic about what the next few decades might look like in that. But what the second part of the question is, so what? Well, what does that do for organization? And the answer is, and we're starting to see this with work from home already, is that one of the surprising implications of work from home is, the other way of calling it is work from anywhere. I could be anywhere, I am anywhere in the world. We can be anywhere in the world and form a firm that can come together and do a thing, right? And whether that's teaching or seminaring or constructing and so on. So that radical pushing of a firm, which was partially solving a monitoring problem. I need you all in the same office so that, you know, for information spillover reasons, we can work together, and, you know, we're more, there's a productivity argument, but there's also a monitoring argument that's there as well. And that notion of just dramatically lowering monitoring and coordination costs suddenly means the main constraint we've got is the time zones. It's just, so long as we're on the same time zone, we can, you know, the costs of this network or distributed organization significantly fall. So again, this is pushing towards more decentralization, but this isn't a market organization. We're not contracting with each other. We're acting as if, you know, we're working in a, you know, Elke and Demset's, you know, theory of the firm sort of way, where we're pooling our resources in this space. But it's distributed pooling of resources. And what's missing here is just these technologies of governance in that space. So there's perhaps a long-winded way of making the point that I think what happens here is that firms still exist, but they become far more networky. They become far more distributed, and the governance of them becomes much, much flatter. And actually will probably look a lot more like a common, will look a lot more club-like or commons-like, using voting mechanisms and so on. And that's the significance of governance tokens and in that space.
Thank you. And I believe Larry White has a question about an earlier statement you made likening money to a public utility.
Let me unmute. Yeah, so you made the statement that money is like or is a public utility. Of course, I think of money as or the payment system as an industry that was nationalized for no good pro-consumer reason. But what do you mean by calling it a public utility?
I mean, I'm on, and just to be clear, I'm very much on the same page with you on this. I think the opportunities for the denationalization of money is one of the great benefits you get out of this. The calling it a public utility in that sense was just trying to draw attention to the idea that this provision of money as a sort of single unit of account or single store of value or those components of it, the logic of why that was, of why governments would provide that, and just completely putting aside all of the benefits to inflation taxes and so on, was to provide was to attempt to sort of lower transactions costs for people using that currency. But the point is, anyone can do that, right? This is the whole point of a private money, is that anyone that can facilitate and provide a digital currency is providing that utility service. So I guess I was just really using that term, perhaps somewhat recklessly metaphorical.
Well, historically, I don't see governments citing that as their rationale. People were already on the same unit of account. Mm-hmm. There was already a clearing system. Governments came along and nationalized it.
Yeah, and I guess that's the implication of it, of seeing that from a perspective of central banking. Then that you've got a sort of a single clearinghouse of the trades and of the payment system that's being run there. But yeah, I think the main point though is that we've through the sort of long central banking period, we've thought of money as a kind of transactional utility that a nation provides. There's no longer any, what
That's
this technology is doing what this technology is doing is enabling really anything or anyone who can persuade others to use it to provide that infrastructure.
So Martin Weiss actually has an interesting point about what aspects of organizational flattening are directly related to blockchain itself, but I'll let him ask his own question.
Yeah, so first of all, Jason, thank you very much for the talk. It was super interesting. I always find your work stimulating. So thank you very much for what you do. There are, just reflecting on a couple of things. One of them was back, I want to say in the early aughts, certainly prior to blockchain, John Hagel and John Seeley Brown had developed a theory very much similar to that about flattening organizations and networked organizations that had nothing to do with blockchain, and actually had some case studies about this. If you're not familiar with the book, I believe it was called The Only Sustainable Edge. It's not an academic piece, but it was certainly an interesting piece.
Yeah, no, I haven't read that book. The argument that we make around this space is opportunity cost. That what blockchains are doing, in essence, is enabling promises to be made and lowering the cost of counterparty monitoring of those promises. Right? So what that means is that the margin of benefit here is that promises work better. These are promises to deliver or promises to pay something if a certain condition is met, or, in a sense, that's what a smart contract is. It's just this ability for me to make a promise to you and for that to be, that promise to be worth more to you because you don't have to incur as many resources monitoring and enforcing and so on that. But it also means that promises are just a more efficient organization of technology rather than governance, rather than hierarchic monitoring and other sorts of things. So the language of that then this is a sort of Williamsonian benefit, that by lowering opportunity costs of promises, you lower the cost of using promises in an economy, which, demand curve sloped downwards means we can use them more, right? So that's kind of what it means this is the microeconomics of how this technology of trust is impacting the way contracts work by lowering the opportunity costs of promises. Now, I think the surprising thing about this is that works without having to go via other intermediate technologies. You don't have to go promises among friends or promises among co-workers or promises among people like me or promises among people that share the same religion or nation state. It just works with promises with people on the internet or promises people that are digitally connected to me. So that notion of changing the margin of, or improving the technological efficiency of the way promises work, which is a somewhat surprise. It's an interesting way of framing what is blockchain technology and why does it disrupt economic organization. But the way we've been thinking about it is that that's it. That's the argument. It's in terms of what the economic implication is, and therefore, everything, all the other technologies that we've used for dealing with promises, such as workplace monitoring, bosses, regulation, media, journalism, just gossip, all of those other social and cultural and legal technologies for dealing with promises, that's the margin that it's competing with them. And that sort of starts as pointing toward at the end of this discussion, that's the historical and social disruption that this is bringing over and above the economic disruption.
So I have another question that was posed as a comment. So hat tip to Mookie Goodson for this comment, which actually kind of harkens to Larry's discussion as well about the political capture of interbank settlement. People tend to like being at a higher node of a hierarchy, or as Lord Acton said, to paraphrase him, people love power but don't always do good things with it. And so this creates an incentive when it comes to potentially disruptive or hierarchalizing media for those in power to prevent or co-opt the emergence of the technology. And so I guess my concern as I'm posing it is, why not fiat blockchains and central bank mediated organizational or central government mediated organizational forms, as opposed to the diversity of private forms that seem to suffuse your analysis?
Yeah, so to my mind, that is the big political economy question right now, is it basically which of those two wins and dominates, and with what consequence. The optimistic view of this is what you've now got is, in the same way that the benefits of federalism is that, and foot voting is that you can only exploit a captive population to the cost of them exiting that sort of situation. What you've now got is, the first order effect is you've now got private institutional infrastructure competition with public institutional infrastructure competition. So we've now got private money competing with fiat money on that margin. So just that competitive effect is likely to discipline the abuses of fiat money or centralized governance. So competition is good for that reason, and we've already got private competition in that space. The second order effect is, what does this then do for intra-government or nation state competition? And that's the one that I think, the central bank digital currencies are the frontier of this right now. So we're seeing China in particular surging ahead aggressively, for better or for worse, into this space. A number of other countries are sort of rapidly looking into it for the same reason, that they're seeing this as a competitive frontier. But the key point about that is two things. One, they're not doing it just for, China isn't doing it just for China. China is doing it for China and all of its potential trading partners. That's the play here, is to create a reserve digital currency that extends not just for Chinese citizens trading with Chinese citizens, but to extend out to denominate anyone potentially trading with China. As in, that's the second part of the Belt and Road Initiative there. So there's that. But then the follow-on point is, why stop at currencies? This is anything, any digital registries that a government is administering fall into this space. So we've got central bank digital currencies. The next step will be central something something digital identity, or central something something digital trade platforms. Now, what those platforms, those government platforms will look like is that they will hard code regulation into them. They will hard code administrative operations into them. We're already seeing this in Australia, and Singapore and Hong Kong is doing a lot of this as well, where the opportunity, or the governments are seeing opportunities to take where they have high quality government administrative infrastructure, digitizing that, putting that into a protocol, and then exporting that administrative infrastructure for essentially other countries or other regions or other regions to use. So we're about to enter the previous name for that was colonialism. I don't know what we're going to call this one, but this notion of taking your administrative infrastructure and pushing it outside the boundaries of your country for integrated trade reasons. Now, that's a central bank digital currency, but that's also central Australian, you can extend that out to monetary regulation, financial regulation. Australia right now is looking at extending out into the Asia Pacific region a lot of Australia's educational infrastructure and regulation, just simply because we export so much of it. But so the question is, what is that? Is that more competition leading to higher quality outcomes, where incompetent governments are outcompeted by high quality administration? But I think that's where we're up to now, is that we've got there's two fronts. There's private versus public competition for governance infrastructure. The example of that is cryptocurrencies, Bitcoin versus central bank digital currencies, for instance. But we've also, what that competition sets up is potentially government to government infrastructure, digital competition. Now, we haven't seen that yet. Like that's the thing that's happening. That's just starting to emerge now. There's a scenario where that is terrifying and in a sort of empire building sense. But there's another sort of global federalism sense where that could actually be a good thing, where you've got where better beats worse, or the ones that citizens want. So again, I think that's where we're up to now with this digital colonialism sort of thing. But the other sort of part of that is that some governments are willing to do this right now and experimenting with it, and often the small agile ones. So everyone points to Singapore or Switzerland as being the sort of leaders in this space, whereas the big EU and America and Russia and so on are struggling with this just simply because they are so big, and it's hard to coordinate that. It's hard to be agile in that space.
No, I think that makes great sense. I guess I'm optimistic in the sense that I think, unlike political institutional change, atomistic changes in economic institutions, initially conditioned by the choices of private actors, can eventually disrupt the political economic rent stream within a given political system. That leads to new political institutions, but then those political institutions are conditioned by jurisdictional competition. And so I'm in the weakly optimistic camp, although I think we should be sensitive to the power of centralized authorities to tamp down on the disruption as and where they can predict it.
No, and that point, the other sort of point just to recognize is that there's more than just blockchain technology at work here. There's also a lot of surveillance technologies and cybersecurity technologies and you know, machine learning, AI, automated decision making. But just that digital tech stack is what is part of the system. I think the significance of blockchain is it's the base layer record keeping component. It's the ledger bit where you just keep track of all of the facts. And then above that is all of the pulling data in, processing it, sending it back out, making decisions on it. But this, I think, this question of whether governments are going to be better at it than private citizens or corporations or coalitions of private citizens is one question. And the other second question is, if this is government head to head, what does that look like as well?
So does anyone else have any questions? I, of course, am a usual brimming font of questions myself, but I definitely want to get the audience involved too. So while some folks are thinking of potential questions, I have a technical question, Jason, when it comes to how you describe blockchain. An area that's recently caught my fancy is structuring a peer-to-peer network surrounding a ledger that's a form of acrylic graph. And so it technically, to my relatively limited understanding, isn't a blockchain because it isn't being replicated in blocks, but graph segments. Are you sort of bundling within the promise of blockchain technology other related distributed ledger technologies for the sake of convenience? Understandable if so. Yeah. But also asking, what do you think about acrylic graphs?
Assume you mean acyclic graphs? Or,
yeah, sorry.
Yeah. So they're all the same. I mean, they're all broadly the same class of distributed technologies. I mean, the thing about sort of acyclic graphs is that they're just they're a technological improvement because they're faster. You can arrive at consensus orders of magnitude faster. So I think we haven't, I mean, we're still at very early stages with a lot of fundamental research in maths and computer science and cryptography around the design and architecture of the types of graphical systems that can be built. They're all distributed, right? Is the common feature that you have across all of them. Whether the consensus mechanism relies on, simultaneous consensus or some sort of other voting mechanism to achieve it. There's lots of different properties, technical properties that can be built. My view on this is that we're likely to end up with a complex ecology of these different technological solutions. They have, some of them are faster and slower. Some of them involve more voting and less voting. Some of them are better suited for staking things. Some are, they're just in the same way that there's no universal technology that you apply for everything. Even different grades of steel are used for different sorts of use purposes. We'll arrive at the same sort of thing. Different classes of blockchain technology or consensus mechanisms will be developed and optimized for different purposes. And that process will just continue, right? Airplanes continue to improve significantly after 1925. I expect blockchains will continue to improve for the same reasons, is that we'll keep finding new uses for them, new margins upon which to improve, as research comes in from, a number of highly fertile fields, from maths and computer science and so on, will advance that. But just, I guess the key to recognize there is that there's a technological frontier that we're just at the beginning of, and will continue to advance. And then there's a institutional frontier of applications, of discovery of economic use cases, which will also continue to advance. This one's entrepreneurial, this one's scientific, as it were. But what is going on is the disruption that blockchain is bringing is both of these technological shifts occurring simultaneously. So, I mean, what that points to me is that this, so far, what is remarkable about blockchain from the perspective of innovation economics is just how fast this technology is moving. I think that will accelerate, or that will continue to accelerate, just simply because of the number of margins that it has to improve on.
So the pace of technological development of blockchain and other distributed ledgers is only accelerating, and you would characterize it as quite fast already. But the frontier of technological adoption is one I agree we should be optimistic about. That being said, there is the heavy hand of path dependence with respect to technological adoption too, especially surrounding network goods. I'm thinking of the classic example of the QWERTY keyboard. And so some people love the Bitcoin network. Others think it's a rather clunky technology compared to some of the other ones available for reconciling distributed nodes that are maintaining the ledger. And so I'm wondering about your thoughts about the risks of us getting a second best technology, even if it is considerably welfare enhancing over the status quo.
Yeah, almost certainly that will happen, and it won't be second best, it'll be 17th best. But the logic of it is important to appreciate. So the thing about QWERTY keyboards and so on was that QWERTY was a network technology. There was no point it's a number of people have to adopt it for it to have value. And this is true of all digital technologies, is that digital technologies are things, compared to industrial technologies, digital technologies, a lot of the value comes from multiple people adopting them, i.e. they're infrastructure institutional technologies. So the problem that you have then is, and it's the same like a money. If it's a money and only I use it, it's not money, right? It's something that we have to agree to simultaneously use for it to have value. So the adoption problem of digital network technologies is coordination. You have to coordinate on, we are going to adopt that one, or there has to be some kind of Schelling point that everyone converges on, we are going to adopt that thing. And in a lot of ways, that's the problem that is the main problem that has plagued blockchain use cases as opposed to, say, cryptocurrencies. And you see this very clearly in a lot of supply chain applications where there's an obvious advantage in moving a supply chain, say an agricultural supply chain, where you've got, say, 27 different parties along a production process, all separate firms, all adopting the same digital infrastructure for moving information along, but all of them have to adopt it to obtain the value of it. So that's a coordination problem. Who goes first? Is it, how do you coordinate on that? If one group adopts one thing and another group adopts a different thing, you've now got a more dysfunctional technology. So the solutions to that coordination problem are one big thing, one big barrier to rapid adoption. The second thing is regulation from a blocking perspective. And the main barriers to a lot of blockchain technology adoption is just regulatory barriers that, for whether they're intended or not, run into problems that a lot of the regulation in finance, for instance, serves very nicely to protect incumbent financial firms and ways of doing things. So in many cases for very good reasons, but they were adopted, they made sense for a particular world. Tech change isn't tech change is the low cost part of it. It's dealing with the regulatory environment that is the main barrier. So the main barriers to the speed of this technology and its economic implications weirdly aren't R&D. They're not, they're not the normal finance research labs, how do we fund the research and to create the new technology? Those aren't the barriers. That stuff's almost trivially cheap. The barriers are coordination of adoption across a network of value and regulatory stand down, or whatever the mechanism is, whether it's exceptions or sandboxes or whatever. My great hope for this is that this is part of the federalism aspect of this, that some jurisdictions, let's pick on Singapore or Switzerland, just do this better than other places, and they become the default platforms or network origins to provide that infrastructure, which then provides competition for other places to engage in deregulation or regulatory stand downs or exemptions or carve outs or whatever needs to be done. Because those are the two reasons that are slowing down the potential productivity gains from the adoption of this tech.
So you just presented, I think, two major obstacles or potential ways in which we get, 20th best instead of 16th best. But we have a question in the chat that I would actually like the poser to ask themselves, because the person who posed it, not poser as in negative connotations of that word, but the posee, I suppose. But anyhow, they're positing a third potential barrier to efficient adoption, or adoption of the most efficient technology. But I want them to ask it themselves. So Mookie, go ahead.
Yeah, so I'll just read what I wrote in the chat, but it mainly has to do with kind of large firms trying to change the way that they're organized. And so I'm wondering how you see the emergence of horizontal networks happening in practice, or because will the reduction of administration and transaction costs chop down the hierarchies of the firm today, or will the benefits be subsumed by larger firms with economies of scale that will just kind of incorporate these benefits into their already large networks? And leave DAOs to kind of more operate in a niche area of DeFi and computer science?
Yeah, it's a good question. It's a hard question. Again, I think there's two answers to this, and it goes to the question, what is the economic benefit or value that a large firm provides? So first of all, large firms are large on the production side. They organize a significant set of resources, a complex set of resources, and they bring monitoring and transaction cost efficiencies, for Coasian reasons to do that. On that, I think they are doomed. This kills them. This is a universal asset through that. And what it does, and a good example of this you can see right now is universities transforming from hierarchies to platforms. But basically, it's a process of unbundling components and reforming them through platform organization, much flatter processes. But that's a from hierarchies to platforms story. So I think that's definitely going to happen. It's happening in finance. I think it'll happen in education. It'll just happen mostly wherever you see large, complex production processes that are currently organized hierarchically. Will move in that direction. So on the production side, massive disruption through unbundling and platformization. So there's that. Now, firms can do that to themselves, right? That's a thing that they can, they're in either large firms can unbundle into platforms, or small networks can sideways integrate into platforms. There's multiple ways you can get to the same point. Small things can join sideways, large things can unbundle. But the other big benefit, and I think this is possibly the more interesting one that large firms have, is large firms have lots of customers. And that's a really nice way to solve a coordination problem. Because the thing about having lots of customers, you've got a single, you're a Schelling point. You go, all right, guess what we're doing? These are the new rules, or this is the new packaging, or this is the new standard. So that ability to take a large number of people with you on a upgrade or tech journey is something that large firms have. But I would emphasize, I mean, not to so much think of large firms in the sort of Amazon sense or the large customer-facing firms. The ones most interesting to me in this respect are consultancies and banks, i.e. B2B firms, ones where everyone works with, say, I don't know, Goldman Sachs or EY, or just pick any, whether it's financial consultancy or management consultancy. The thing about being a large corporate consultancy is you've got lots of corporate customers and you can take them all on a journey together. So that notion of and again, it's the thing about, it's the same thing. It's the thing about being large is that you can solve a coordination problem in a way that being small, you can't. So I sort of sense those are the two forces, this unbundling, de-hierarchicalization, destructive force, which will, versus or with this large, we've got a lot of people in our net. And we can take them on a journey together. So a coordination to solve a coordination problem of a tech upgrade. Now, again, governments are also another solution to that. A government can just regulate a standard, and guess what? You all have to follow the standard now. Now so there's a very sort of different, there's a number of different solutions to this, some of which are more voluntary and some are less voluntary than others. But I actually think it's particularly interesting when companies like IBM and so on are very blockchain forward, not because they're a tech company per se, but because they've got a lot of customers, or a lot of people run their digital infrastructure. And when they shift their digital infrastructure, that means a lot of companies in the economy also shift with that. So now again, there's a fourth order effect around competition policy and antitrust about the implications of that. But I think that this notion of just really thinking hard about tech, of thinking hard about technological innovation from a coordination perspective is really interesting, and is especially interesting in this blockchain space.
I couldn't agree more, Jason. And unfortunately, we are coming up against time. As my final moderator prerogative, the IBM and Deloitte's interest in blockchain reminds me of Christensen, the recently late Clayton Christensen's point about, hey, if you're worried about disruptive innovation as a firm, figure out how to bring the disruption within your own firm. Yeah. How successful they'll be in doing so, I think, is an open question, but I want to thank Jason for his thoughts here today, and I will again humbly entreat him to send me his slides so we can get them posted up on the associated website. But this has been really fascinating, and just thanks again, Jason.